All right, pause your scroll for a second because something just snapped in the silver market, and it didn't happen quietly. If you've been watching prices casually, you probably missed it. But if you're paying attention right now, you're seeing silver rip through levels that were supposed to take years, not hours. In the last couple of hours, Western spot silver pushed above $121, while Shanghai spot printed $139. And futures in China? $146.17. That's a $26 gap, live, right now. This isn't noise. This is the kind of dislocation that tells you something underneath the market just broke. If you're holding physical, you need to understand what's happening. If you're watching from the sidelines, you need to see how these patterns form before they explode. Stay with me, because I'm going to show you what actually triggered this move, how to read these signals in real time, and why this pattern matters whether you own silver or not. Before I explain what caused this move, let me teach you something most people never really learn about metals markets. When you see a price on a screen, you're usually looking at paper, contracts, promises, not metal. Physical silver lives in a completely different world with different pressures and different limits. Think of paper silver like airline tickets. You can sell a lot of seats before the plane ever leaves the ground. Physical silver is the actual plane. When too many tickets get sold and the plane fills up, something has to give. That's what you're watching now. The price gap between Western paper markets and Asian physical markets is the stress fracture forming right in front of you. So what does that tell us? It tells us that the market's pricing mechanism is splitting into two realities, one where contracts trade hands electronically, and one where actual metal changes custody. And when those two realities drift too far apart, the market corrects violently. If this is making sense so far, drop a comment and let me know where you're watching from, because I want to know how global this audience really is. Now here's what's actually happening, step by step, because you need to see the cause and effect chain. China's physical demand has been relentless, and Shanghai prices have been signaling tightness for weeks. But now, that signal turned into a siren. Spot silver in Shanghai surged past 139, futures followed to 146, and suddenly Western markets were left staring at an $18 to $26 premium they couldn't ignore. That premium is the market screaming one thing: physical is scarce. At the same time, refiners like Perth Mint and Metalor halted new orders. That's not bullish hype. That's supply chain triage. When refiners stop taking orders, it means they don't have metal, or they don't trust delivery timelines. You don't shut down revenue unless the alternative is worse. And what's worse? Promising delivery you can't fulfill. So that's layer one. But here's layer two, and this is where it gets interesting. Vault inventories are dropping. ETF inflows are hitting records. Industrial demand from solar and tech isn't slowing, it's accelerating. You've got jewelry fabricators competing with solar manufacturers, competing with investment buyers, all pulling from the same limited stockpile. And here's the thing about industrial demand. It's not price sensitive the way speculative demand is. If you're building solar panels and you need silver, you need silver. You don't have a substitute that works as well. So when physical buyers step up and paper sellers can't source metal, the paper price has to chase reality. But paper markets don't like to admit when they're wrong. They adjust violently. Now here's the convergence that makes this a structural event, not just a spike. When you combine relentless Eastern demand with Western supply constraints and record investment inflows, you get what's called backwardation. That's when the spot price trades higher than futures prices. It's the market's way of saying metal today is worth more than metal tomorrow, because metal today might not exist tomorrow. And backwardation in silver is rare. When it shows up, it's a red flag that the delivery system is under stress. But here's the part that should make you nervous. Paper markets can stay irrational longer than physical markets can stay patient. When that first domino falls, here's the cascade. Physical premiums blow out. Arbitrage desks try to move metal east. They can't find enough. Futures spike to entice sellers. Margin requirements creep higher. Volatility explodes. And suddenly, everyone who thought silver was just another commodity realizes they're standing in a structural supply deficit. This isn't about speculation anymore. It's about delivery. And delivery is binary. Either the metal shows up or the price resets until it does. Now zoom out with me, because this isn't random. This is the exact same playbook we saw in the late 70s, when silver ran into a physical squeeze and prices disconnected from traditional valuation models. In 1979 and 80, the Hunt brothers tried to corner the market, but underneath that drama was a real supply deficit. What happened next? Silver went from $6 to $50 in less than 2 years. Same pattern: physical tightness, then backwardation, then price dislocation, then parabolic repricing. We saw it again in smaller form during the 2011 run, when investment demand collided with industrial use. Silver ran from $17 to nearly $50 in less than 5 months. Every time this setup appears, it starts with backwardation, then inventory drawdowns, then regional price gaps, and finally, a repricing event that feels sudden but wasn't. And here's what people miss. When you look at the pattern, silver doesn't move smoothly. It stays quiet for years, then it jumps stair-step style when the system can't absorb demand anymore. The larger story is simple. Supply has been in deficit for multiple years. Demand didn't blink. Now the bill is due. This is the third time in 50 years we're seeing this pattern play out in real time. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this reverse? Sure. Margin hikes can cool speculative excess. Governments can jawbone markets. Central banks could coordinate liquidity injections. Short-term pullbacks are normal, even violent ones. And not every price spike turns into a straight line higher. We've seen false breakouts before. Could this be manipulation by large players trying to force a squeeze? Maybe. Could this be a temporary disbalance that resolves in days? Possibly. But here's the thing. It doesn't actually matter whether someone's pulling strings behind the curtain. The mechanics are what matter. Focus on what you can control and what you can measure. None of those interventions create silver. They only manage behavior. The physical math doesn't change. So instead of arguing about manipulation or conspiracy, look at what you can actually verify. Physical premiums, delivery times, inventory reports, refinery order books. Those don't lie for long. If you're building a thesis on fundamentals, you have to stay anchored to data that can't be easily manipulated. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situations are different. Maybe you're already positioned in silver. You bought physical months ago, or you're holding mining stocks, and you're wondering if this is the top. Should you take profits? Should you ride it higher? Let me be honest with you. Tops don't usually come with widening physical premiums and halted refinery orders. Tops come with euphoria, with everyone you know asking how to buy silver, with premiums collapsing as supply floods the market. We're not there. Manage your risk, sure. If you're up significantly, there's nothing wrong with taking some chips off the table. But don't ignore the signals that got you here in the first place. If the fundamentals that made you buy are still intact, and they appear to be, getting shaken out by volatility is how people miss the real move. Maybe you're on the sidelines feeling late. I get it. Chasing parabolic moves feels awful. You watch something double and your brain tells you the opportunity's gone. For you, patience and scale matter more than prediction. Let the market breathe. Watch for consolidation that holds higher levels. If silver pulls back to 110 and holds, that's information. If it consolidates sideways for weeks, that's actually healthy. Don't try to time the exact bottom of a pullback. Use scale and strategies. And remember, in bull markets, the second leg often surprises more than the first because fewer people expect it. You're not too late if the structure is still intact. And maybe you're just trying to learn. You're trying to understand how these things work before putting real money on the line. That's smart. That's the right approach. For you, this is a masterclass. Learn how paper and physical diverge. Learn what stress looks like in real time. Study how backwardation forms. Watch how Eastern and Western markets interact. This education is worth more than any single trade because once you understand the patterns, you'll see them forming in other markets too. The universal rule for all of you is the same. Don't anchor to price alone. Anchor to structure. Price is just the symptom. Structure is the diagnosis. So here's what I want you to answer in the comments. Where are you in your silver journey? Are you positioned, waiting, or still learning? And what's your biggest question about what's happening right now? Because I read every comment, and the questions you ask shape what I cover next. Here's where I stand personally, and I want to be clear about this. I'm not calling exact tops or bottoms. I'm not telling you silver hits 200 or crashes to 90. I'm watching signals and sharing what I see. Let me tell you what I'm personally watching right now. First, I'm watching Shanghai premiums relative to Western spot. If that gap narrows naturally without price collapsing, that's healthy arbitrage at work. If it widens further, that's escalating stress. Second, I'm watching delivery volumes and reported vault inventories from the major depositories. COMEX stocks, ETF holdings, refinery backlogs. When inventories drop during a price surge, that confirms physical demand, not just speculative froth. Third, I'm monitoring margin changes and exchange behavior. When exchanges hike margins aggressively, they're trying to cool speculation. That can cause sharp pullbacks, but it doesn't change the underlying supply equation. Based on my analysis, this move was mechanical, not emotional. The fundamental picture didn't weaken, it validated. You've got refiners halting orders. You've got persistent backwardation. You've got record premiums in Asia. You've got vault drawdowns during a price surge. Every one of those signals points the same direction. The physical market is tight, and tight markets don't resolve with gentle corrections. They either break the tightness with massive new supply, which doesn't exist, or they reprice to a level where demand finally backs off. We're in the repricing phase right now, If history rhymes and silver follows the pattern of 79 or 2011, the move that follows a breakout like this can run further and faster than anyone expects, because most participants still think in terms of the old trading range. But I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Talk to people who've traded through these cycles before. Your risk tolerance isn't mine. Your timeline isn't mine. Make decisions that fit your situation. If you made it this far, you're thinking critically instead of reacting emotionally. That mentality will serve you well in every market you ever trade. Hit that subscribe button if you want more breakdowns like this, because I'm going to keep tracking these developments as they unfold. Share this with someone who needs to see it, someone who's asking questions about what's happening right now. Stay sharp out there. Think for yourself. Verify the data. And make decisions that fit your risk, not the crowd's excitement. I'll see you in the next one.